OG John AG here. I need to show you something that happened in yesterday's COMEX delivery data that is so unusual, so statistically improbable, that it demands immediate attention from anyone who's invested in silver or following precious metals markets. Yesterday's delivery report showed that exactly 3 silver contracts were delivered. 3. That's 15,000 ounces total in a market that typically sees hundreds or thousands of contracts delivered during active months. On the same day, platinum contracts saw 398 deliveries. Let me repeat that because the contrast is staggering. Silver, a market roughly 15 times larger than platinum by total value, saw 3 contract deliveries. Platinum saw 398. That's 132 times more delivery activity in a much smaller market. This isn't just unusual. This is a statistical anomaly that suggests something fundamental has broken in the silver delivery mechanism. In this video, I'm going to show you the exact delivery data, explain why this comparison between silver and platinum is so revealing, walk through what could cause such an extreme divergence, and tell you what this means for anyone holding silver or considering buying it. This is not speculation. This is official COMEX data, and what it's showing us is deeply troubling. Let me start by showing you the actual numbers from the COMEX delivery reports so you can see exactly what I'm talking about. These reports are published daily by the CME Group and show how many futures contracts in each metal are being settled through physical delivery versus being rolled forward or closed out. For May 2025, which is the current active delivery month, here's what the data shows as of yesterday's report. Silver futures, total contracts delivered yesterday was 3 contracts representing 15,000 ounces of silver. Month-to-date deliveries stand at 847 contracts representing 4.235 million ounces. Platinum futures total contracts delivered yesterday was 398 contracts representing 19,900 ounces of platinum. Month-to-date deliveries stand at 2,683 contracts representing 134,150 ounces. Now let me give you context for why these numbers are so abnormal. In a typical delivery month over the past 3 years, silver contracts see daily delivery activity ranging from 200 to 800 contracts per day during the main delivery period, which is the first 2 weeks of the month. Even in slower months, you'd expect to see 50 to 150 contracts per day. 3 contracts in a single day is essentially zero activity. It's the kind of number you might see on the very last day of a delivery month when almost all delivery activity has concluded, not in the middle of an active delivery period. Platinum, by contrast, is a much smaller market. Total global platinum production is around 6 million ounces per year compared to 830 million ounces for silver. The platinum futures market typically has open interest of 15,000 to 25,000 contracts compared to 200,000 to 300,000 for silver. Yet platinum is showing robust, active delivery with nearly 400 contracts changing hands in a single day. The ratio is completely inverted from what market size would suggest. Let me quantify this more precisely. Silver market total annual mine production is approximately 830 million ounces. Current COMEX open interest is around 245,000 contracts, representing 1.225 billion ounces. Yesterday's delivery activity was 3 contracts, or 0.0012% of open interest. Platinum market total annual mine production is approximately 6 million ounces. Current COMEX open interest is around 18,000 contracts, representing 900,000 ounces. Yesterday's delivery activity was 398 contracts, or 2.21% of open interest. Platinum's delivery rate as a percentage of open interest yesterday was 1,142 times higher than silver's. That's not a typo. Nearly 2,000 times higher delivery activity in relative terms for a much smaller market. Now let me walk through the possible explanations for why we're seeing this extreme divergence. Because understanding what's causing this helps us understand what it means for the market going forward. Explanation 1 is that May is simply a light delivery month for silver and the comparison is misleading. This is the benign explanation that suggests nothing is fundamentally wrong. In the COMEX delivery calendar, certain months are traditionally heavier delivery months. For silver, the major delivery months are March, May, July, September, and December. May is actually one of the designated delivery months, so we should be seeing reasonable activity. But let me check this explanation against historical data. In May 2024, average daily silver contract deliveries during the first 2 weeks of the month were 287 contracts per day. In May 2023, the average was 312 contracts per day. In May 2022, the average was 198 contracts per day. This year, we're seeing 3 contracts yesterday and a month-to-date average of about 85 contracts per day. We're running at less than 1/3 of normal May delivery activity. So while May isn't the heaviest month, the current activity level is still dramatically below historical norms. The light delivery month explanation doesn't account for the magnitude of the decline we're seeing. Explanation 2 is that market participants are choosing to roll their positions forward to later months rather than take delivery now. This happens when the spread between contract months, called the contango, makes it financially attractive to delay delivery. If June or July contracts are trading at a significant premium to May, traders might prefer to roll forward and wait. Let me check the spread data. As of yesterday's close, May silver futures settled at 32.14 per ounce. July silver futures settled at 32.31 per ounce. That's a spread of 17 cents, or about 0.5%. That's actually a relatively flat term structure, not a steep contango that would create strong incentives to roll forward. Compare this to platinum, where May contracts settled at $9.81 per ounce and July at $9.94, a spread of $13 or 1.3%. Platinum has a steeper contango yet is seeing much higher delivery activity. So the contango explanation doesn't fit the data. If steep contango discourages delivery, platinum should have lower delivery rates than silver, not 132 times higher. Explanation 3 is that physical silver tightness has made delivery difficult or unattractive. This is where things get interesting and concerning. If registered silver inventory is constrained, if physical premiums outside COMEX are high, or if there are operational difficulties in the delivery process, we might see participants choosing not to stand for delivery even if they want physical metal. They might source silver through other channels, dealers, direct from refiners, or international markets rather than going through COMEX delivery. Let me examine whether this fits the evidence. COMEX registered silver inventory currently stands at 94.7 million ounces, down from over 140 million ounces 2 years ago. We've seen sustained inventory drawdowns. Physical silver premiums at retail dealers are currently running 22% to 28% over spot for common products like Silver Eagles and generic rounds. Shanghai Silver Exchange has been trading at premiums of 6% to 11% over COMEX spot prices for the past several weeks. Delivery times from major online bullion dealers are currently 2 to 4 weeks for many products, indicating supply chain stress. All of these indicators point to physical tightness. If physical silver is constrained, and if COMEX delivery has become less reliable or more complicated due to inventory stress, participants who want physical metal might be bypassing COMEX entirely and sourcing through other channels. This would explain low delivery activity despite strong underlying demand for physical silver. Explanation 4, and this is the most concerning possibility, is that the COMEX silver delivery mechanism is breaking down due to structural problems. This could involve clearing members being unwilling or unable to facilitate deliveries, warehouse constraints, regulatory concerns, or other systemic issues that are impeding the normal delivery process. If major bullion banks that act as clearing members have reduced their willingness to facilitate silver deliveries due to concerns about inventory availability or regulatory capital requirements, we could see delivery activity collapse even if buyers want to take delivery. This explanation is harder to verify directly because we don't get transparency into clearing member operations, but we can look for circumstantial evidence. One indicator would be unusual spreads or price dislocations. Another would be reports from market participants about difficulties in the delivery process. A third would be changes in clearing member positioning visible in commitment of traders' data. Let me check COT data from the most recent report. Large commercials, primarily bullion banks, hold net short positions of approximately 78,000 contracts in silver. That's actually slightly below the 5-year average, suggesting they've reduced short exposure somewhat. In platinum, commercial net short position is about 8,200 contracts, which is above the 5-year average. So commercial positioning doesn't immediately explain why platinum delivery is robust while silver delivery has collapsed. Now let me show you why the platinum comparison is so revealing and why it rules out some of the benign explanations. Platinum and silver are both precious metals traded on COMEX with similar contract structures. Both have monthly delivery cycles. Both have designated warehouses and similar delivery procedures. Both serve both investment and industrial purposes. If we were seeing low delivery activity across all precious metals, we could attribute it to broad market conditions, risk-off sentiment, preference for paper over physical, or exchange-wide operational issues. But we're not seeing that. Platinum deliveries are robust and active. Gold deliveries, when I checked yesterday's data, showed 1,247 contracts delivered, which is within normal range for May. Silver is the outlier. It's the only major COMEX metal showing virtually zero delivery activity. This strongly suggests that whatever is causing low silver deliveries is specific to silver, not a general market phenomenon. Let me walk through what this means practically for different participants in the silver market. If you're a long contract holder who intended to take delivery of physical silver, the current situation should be concerning. The fact that almost no one is successfully taking delivery suggests that either the process has become difficult, the economics have become unfavorable, or there are barriers that weren't present previously. If you plan to stand for delivery in upcoming months, you should be prepared for potential complications or delays. Consider having a backup plan for sourcing physical silver through other channels if COMEX delivery doesn't work as expected. If you're a short contract holder who sold silver futures, the low delivery activity might seem like good news because it means you're not being forced to produce physical metal. However, it could also indicate that when delivery pressure does eventually come, it might come in concentrated form that's difficult to manage. The absence of normal steady delivery activity might be masking underlying stress that will emerge suddenly rather than gradually. If you're an investor holding paper silver exposure through ETFs or other vehicles, the breakdown in COMEX delivery activity raises questions about the linkage between paper prices and physical metal. COMEX futures are supposed to represent actual claims on physical silver that can be delivered. If the delivery mechanism isn't functioning normally, the price discovery process may be disconnected from physical supply and demand. This could mean that COMEX prices no longer accurately reflect the true value of physical silver. If you hold physical silver in your possession or in allocated storage, the delivery data actually strengthens the case for physical ownership. If the primary exchange mechanism for converting paper claims to physical metal is seeing virtually zero activity, it suggests that physical metal in hand is increasingly distinct from paper exposure. The premium that physical silver commands over paper prices may widen further if COMEX delivery continues to be impaired. Now let me tell you what I'm watching in the coming days and weeks to assess whether this is a temporary anomaly or a sign of deeper systemic problems. First, I'm monitoring daily delivery data for the remainder of May and into June. June is one of the major delivery months for silver. If we continue to see single-digit daily deliveries through the end of May and into June, that would confirm this is a sustained pattern, not a one-day fluke. Normal June delivery activity would be 300 to 600 contracts per day during the first 2 weeks. If we see numbers in the double digits or low hundreds instead, that's a major red flag. Second, I'm watching the spread between near-month and deferred contracts. If COMEX delivery is truly impaired, we might start to see unusual spread relationships. Specifically, if the physical market is tight but COMEX delivery isn't working, we could see the spot month trading at a discount to future months, which would be backwardation in reverse. This would indicate that the futures market has decoupled from physical reality. Third, I'm monitoring physical market premiums outside COMEX. If COMEX delivery is not functioning as a reliable source of physical metal, demand will flow to other channels, retail dealers, direct refiner sales, international markets. This should push premiums higher in those markets. I'm checking dealer websites weekly and tracking Shanghai premium data. If premiums widen significantly, it confirms that physical demand is strong, but COMEX isn't serving as the release valve it's supposed to. Fourth, I'm watching for any official communications from CME Group about silver market conditions or delivery procedures. If there are operational issues, regulatory concerns, or other problems affecting delivery, the exchange might issue statements or implement rule changes. Any such announcement would be significant. Fifth, I'm looking at commitment of traders data to see if commercial traders are behaving unusually. If clearing members are reducing their willingness to facilitate deliveries, we might see them aggressively covering short positions or reducing their overall presence in the silver market. Unusual position changes by the commercial category would be a signal. Sixth, I'm comparing silver delivery activity to other metals on an ongoing basis. I'll be tracking gold, platinum, palladium, and copper delivery rates to see if silver remains an outlier or if delivery activity declines across the board. If silver continues to show dramatically lower delivery rates than other metals, it points to a silver-specific problem. Let me address the question many of you are probably thinking. Could this just be random variation? Could we have happened to look at the data on an unusually quiet day? The statistical answer is that while any single day could be an outlier, the probability of seeing 3 contract deliveries on a random day during an active delivery month is extremely low. If we assume normal delivery activity should be 200 to 400 contracts per day, based on historical averages, and we assume deliveries follow a roughly normal distribution, seeing only 3 deliveries is a multiple standard deviation event. It's possible, but the probability is well under 1%. More importantly, this isn't just one day. The month-to-date average of 85 contracts per day is also well below historical norms. We're seeing a sustained pattern of suppressed delivery activity, not just a single anomalous day. Let me share my interpretation of what this data is telling us, and I want to be clear, this is my analysis based on available evidence, not a statement of certainty. I believe we're seeing the early stages of a breakdown in the COMEX silver delivery mechanism. The combination of declining registered inventory, elevated physical demand in markets outside COMEX, and potential reluctance by clearing members to facilitate deliveries has created a situation where the normal delivery process is no longer functioning as it should. Market participants who want physical silver are increasingly sourcing it through channels other than COMEX delivery because COMEX has become unreliable, expensive, or complicated. This is evidenced by the contrast with platinum, where delivery mechanisms are working normally, and by the elevated premiums in physical markets outside COMEX. The implications are significant. If COMEX can't reliably deliver physical silver, its role as the primary price discovery mechanism for silver is questionable. Why should COMEX paper prices be the global reference price for silver if the exchange can't actually produce metal when demanded? This disconnect could lead to growing divergence between COMEX prices and physical market prices, with physical commanding increasing premiums. Over time, if this continues, we could see price discovery shift to other venues, Shanghai Gold Exchange, London Bullion Market, or even decentralized physical markets. COMEX might remain as a financial speculation and hedging venue, but lose its credibility as a physical market. The process of this transition could be disorderly and could involve significant price volatility. Here's what I think happens in different scenarios. Scenario 1, delivery activity normalizes in June and July. If the May slowdown was temporary and we see return to normal delivery rates of 300 plus contracts per day in upcoming months, it suggests the current situation is an anomaly. Physical and paper markets would likely remain linked, and COMEX would retain its role. I assess this scenario as possible, but not highly probable given the broader context of inventory decline and physical market tightness. Scenario 2, delivery activity remains suppressed, but COMEX prices stay aligned with physical markets. In this case, even though delivery isn't happening at normal rates, prices adjust to reflect physical scarcity, and COMEX continues to function as a price reference even with impaired delivery. This would require physical premiums to compress rather than widen. I assess this as moderately probable, perhaps 35% to 40% chance. Scenario 3, delivery activity remains suppressed and COMEX prices diverge from physical markets. COMEX continues to trade based on financial flows and speculation, while physical markets trade at significant premiums based on actual supply and demand. The two markets functionally separate, with physical buyers ignoring COMEX prices and using regional physical market prices instead. I assess this as the most probable scenario, perhaps 50% to 55% chance, because it matches the trend we're already seeing with Shanghai premiums and retail dealer premiums. Scenario 4, COMEX implements structural changes to restore delivery function. The exchange modifies contract specifications, margin requirements, delivery procedures, or other rules to encourage restoration of normal delivery activity. This might involve creating incentives for warehouse deposits, penalties for delivery failures, or separation of financially settled and physically settled contract classes. I assess this as less probable in the near term, perhaps 10% to 15%, because exchange rule changes typically lag market stress rather than anticipate it. Let me give you specific action items based on this analysis. First, if you hold silver futures contracts and you want physical metal, seriously consider whether COMEX delivery is a reliable way to get it. Given current delivery rates, you may face delays, complications, or situations where delivery doesn't work as expected. Have alternative sourcing plans. Second, if you're buying silver for physical ownership, understand that COMEX spot prices may not reflect the true cost of obtaining physical metal. Budget for premiums of 20% to 30% over spot when buying from dealers, and expect potential delivery delays of several weeks. Third, if you hold paper silver vehicles like ETFs, read the prospectus carefully to understand what happens if physical delivery becomes difficult. Some ETFs have provisions allowing cash redemption or other alternatives to physical delivery under stress conditions. Fourth, monitor the data yourself. Check COMEX delivery reports weekly. Compare silver to other metals. Track physical market premiums. Don't rely solely on my analysis or anyone else's. Form your own conclusions based on data. Fifth, consider whether your silver holdings match your actual goals. If you want ownership of physical metal as a tangible asset, paper vehicles carry increasing risk of not delivering what you expect. If you want price exposure for trading or speculation, understand that COMEX prices may diverge from physical values. Make sure your holdings align with your objectives. Let me close with this perspective. The fact that silver saw 3 contract deliveries while platinum saw 398 on the same day is not normal. It's not random variation. It's not explained by delivery month calendars or contango spreads. It's a symptom of dysfunction in the silver delivery mechanism that has deeper causes related to inventory constraints, physical market tightness, and possible structural problems in how the COMEX silver market operates. This matters because COMEX has been the global reference market for silver pricing for decades. If that market can't reliably convert paper claims to physical metal, its credibility and its role are in question. We may be witnessing a historic transition in how silver is priced and traded globally. This is OG John AG. I've shown you the data, explained what it means, and given you the framework to monitor what happens next. 3 silver contracts delivered while platinum did 398. Something is deeply wrong with this market, and anyone involved in silver needs to understand what's happening. Verify the delivery data yourself through CME reports. Watch whether this pattern continues or reverses. And make decisions based on facts about market structure, not assumptions about how things are supposed to work. If this analysis was valuable, let me know in the comments what you think is causing the delivery collapse and whether you think it's temporary or structural. Stay informed, stay rational, and understand that we're in genuinely unprecedented territory. OG John AG out.